Okay, hey, this is Diver. This is going to be part 3. So, in the money, at the money, Elliott Wave, and yield is what I'm going to talk about in this video. This is should cover just about everything that I've been trying to get across. So don't forget to watch parts 1 and part 2 if you haven't seen that. But in general, this should explain everything regarding in the money and at the money puts and yield, and I will talk briefly about covered calls as well. Okay, at the end of this video, I hope that you can decide whether options selling, options trading, however you want to approach it, is either good, bad, or, as we say, ugly for the movie's sake. It's your decision. You have to do your own research, your own training, your own investigation, and try to decide what's best for you. So anyway, I want to revisit the teaser that we put out on Twitter. This is about, in essence, freezing the options chain. So I'm going to pull up an options chain and just go over this concept one more time. This is for the OG apes. It's for all the people who, have all of this drama on Twitter and drama on Reddit. I'm just throwing out an idea that really I think is just simple and it would work. And that's me. Simple. Diver. Simple. Okay, I pulled up an options chain on AMC. The current price is like $40. And this is November 19th and it's still around $40. So here we go. If I had, $1 billion, I could sell a put. I could sell puts. Here we are at 39. I could sell 1 million contracts. We currently have an open interest of 826 contracts at 223 premium. If I had enough money, I could sell 1 million put contracts at this strike 39. And so what would happen? Well, obviously the bid would probably go just to zero because that's 1 million contracts. The other thing that could happen is the price going to go to 39? Well, it might, because the market makers or the buyers or whatever wouldn't have to exercise. Right? This I didn't make clear in my original video on this concept, but think about it. If you had 1 million contracts, never been done before, I can't do it by myself because it's an I concept. If I did it, the real concept is, at the end of the day, it's going to be a concept. But I can't really do that. Anyway, so if 1 million contracts went, this is open interest. If 1 million contracts sold, here's volume 195, it's strike price 39. If 1 million contracts sold, that's 100 million shares that market makers or whoever put up the offer would have to sell me at this strike price. Do you get that concept? So what really happens? Nothing may happen. Maybe it goes to 38 and nobody exercises, but that would be pretty strange. Regardless of what happens, if the current open interest and volume creates $2.23 of premium and that goes to zero, think about what happens then. If that premium goes to zero, no one gets any hedge money. The market makers gets no hedge money. I just simply am putting that out there for everybody to think about. While y'all talk about drama and you talk about this and that and charting and, this person and that person coming in with NFTs and everything else, I'm simply saying, look at the options chain. This is how the institutions, the market makers, the hedge funds control everything. And you'll see by the end of this video, I will show you today on November 19th how it's exactly controlled. And, it doesn't always work this way. I've been trading 40 years. It doesn't always work this way, but in general, it works this way. So think about this options chain. volume, open interest, and think 1 million contracts. Gee, I think there's million retail investors. One contract each? Contracts. I can't even imagine the damage that would do. I'm just saying, like I always say on Twitter, I'm just saying. Okay. Okay, like I said before, you got to watch part one, part two. These are out of the money puts. We're talking about selling puts. I'm going to throw out a little bit about selling calls as well, but in general, I will describe the risk to that. And so I've pulled up an options chain so that I can talk about close to the money and at the money and in the money puts. So what is in the money and what's at the money? So here we are at, this is again AMC. This is the strike price, and that means the option contract price. So I really don't want to go over this over and over again, but you got to pay attention to what I'm talking about. This is the strike price, and these are the options premiums that you can bid or sell for, buy or sell. Okay, so here we are. In the money would be this at this current time, and this was somewhere back before October 22nd, because there's the options chain, and I pulled up to November 5th expiration date. Okay, so you should, by now, if you watch part one and part two, you're going to understand how expiration dates work. And on AMC, it's every Friday. Friday. Okay, so now we're already now at this date when I'm making this video, but we go back, and at this time, and in the money put at 37 strike, the price of the stock at this moment is $36.65. So an in the money put is 37. If you sold that put at 37, you would get $2.96 a share, 100 shares per contract. That's $296 in your pocket. Okay, just want to explain what an in the money put is. If you went close to the money, you would sell a 36, right? So that will give you $237. Or as I did for this example, I sold one at 35 at this point. The bid is 187. The ask is $2.12. I filled this at $2.09. That means I got $209 for a strike price of 35 while the stock was selling at 36. Okay, so just to show this information now, and you maybe on this video, you may want to go back and forth because you can learn a lot from this video. Here you were at a delta 36. Okay, so that's that's the definition of in the money and close to the money or at the money puts. Okay, so how are you going to decide whether this is a good price or not, or whether this is risky? So obviously if I sell a 35 put and the price goes to 35, I'm going to get assigned, right? If the price goes to 35 by November 5th and I leave that thing alone, if I don't do anything about it, I'm going to get assigned the stock at 35. So, there's different philosophies on how you want to decide what you're doing when you make the trade. And this goes back to what I originally talked about. Also, it's basically based on a decision. Do you want the stock at this price? If you want the stock at this price and you were going to buy it anyway, why wouldn't you want to put $237 in your pocket or $296 in your pocket? So that's one concept. If you want to forecast that you think the price is going to go down and you want to target the best price you can get, then you're going in this area. And again, if you go way out of the money, you simply don't want the stock, and you sell it at whatever price that you can get where you feel safe. Okay, in order to define where you decide what price you're going to use, this is the crux of this video. How to chart and do technical analysis, and I'm not going to go into detail on those, but I'm going to give you a brief introduction as to what, goes into the decision-making process as to where that price is going to be. And to do that, I have to repeat a little bit about yield, and maybe I do a little bit more detail there, and a bit more on the Elliott Wave, and some simple charting techniques just to get people started. And fundamentally, by the end of this video, you should see that selling puts is easy. It's not rocket science. It can be done without a whole lot of experience. And in my opinion, it's simply safer than simply buying a stock. And it's for sure a lot safer than trading calls, purchased or bought calls or puts from that side. So from the sell side, it's probably one of the safer things that you can do when they're cash secured puts and covered calls. So now I've pulled up a full chain, and this is also on AMC. It's still here, the same one, $40 a share. So now you have the put and the call option chain. And so again, I talked about yield, and so this is the most important part. So if you're looking to enter at a price, first the yield has to make sense. So, I have to explain good yield and bad yield. If you're looking at yield, you have to look at the strike price, the bid. Just always use the bid for your thought process, because if you are selling a put at a certain strike price, and this is the stock price, this is the strike price that you're trying to trade at, you have the bid and the ask, and somewhere in between there you can usually get a fill or a contract. But you can always get one on the bid. If you place an order on the bid, at least with E-Trade, you're going to get it instantly. Okay, so that's how that works. So I want to explain that AMC, because I've been stating this for 10 months on Twitter, it's a money machine. You can always get a minimum of 50% yield somewhere even out of the money on a weekly. Okay, so when you're trading weeklies, here's a weekly. This is November 26th. This is the week we're in right now. This is the expiration date of today when I'm making this video. Okay, and remember this number 40 because it's critical. Anyway, so when you're looking at yield, you must first take 1% of the strike price. Well, look at these. Just multiply this out. You have a strike price of 36 and you got a 96 cents on the bid. So it's way more than 1%. So, but it's not always like that. If you are trading other stocks, some stocks simply do not have any good yield whatsoever. So I pull up an options chain on General Electric because I traded this stock for 2 years and I actually did fairly well with it, but you got to go a little bit beyond doing weeklies. So on a weekly, GE at the time I did the screenshot, was trading at 107.59. Okay, so if you took the at the money strike put, it was selling for 118 or $1.18. Okay, on $100. So that's 1%. So that's the bare minimum. But as soon as you drop one strike away from at the money, you're already below 1%, and it falls off really fast. So if you were selling a 99.50, which is fairly safe, but you're getting 17 cents, so you're not getting the yield for this kind of trade. So that's the first step. You want to look at yield, and that's simply 1% of the strike price on a weekly. Simple. It's not rocket science. It's not math. This math is simple. 1% of this strike price is 50% yield per year. And rough estimates, okay? So that's the simple math, and you don't need to get too carried away with it. You only need to look at strike price, and you look at the bid, and then you see, this has to be $1.06 to be 1%, but it's not. But this is, okay? So I would take this trade. That's 50% per year. However, AMC in general will run you 10%. So if you're on a weekly, you're making, 500% per year, 200%, 100%. That's, yeah, a whole lot better. So, okay, I'm back on AMC options chain. And, one thing that makes a difference in how you decide what you're doing is there's two scenarios, and these apply to me quite well. One, are you watching all the time? Do you have time to watch? If you're a day trader, or are you watching all day long, and you have access to your phone and everything else? You can probably pick the optimum price and do it that way. Otherwise, you're simply just taking the premium. So I trade both ways. Sometimes I have time to watch the market, sometimes not. If I sell puts, I sell puts on red days. I buy to close them on green days. If I sell a call, I'm selling the call on a green day and buying to close it on a red day. Okay, so that's the fundamental concept. Sometimes, if you wait for velocity, you wait for the best price, everything, you're charting and doing all this stuff, you can, make the absolute best premium. But if you don't have time to watch the market all day long, then you can't do that. But the beauty of selling options as opposed to buying options is that when you're selling options, you really don't have to watch it that much. You only need to pick the price. You simply aren't going to make as much money. So you don't need a big strategy. You don't need a complex analysis to see where you're going to be in 2 weeks. And this here is the most let me throw this out there, because this is really the concept. When you sell options, you only need to know where the stock is not going to go. That might make sense, hopefully. If you are buying options, you need to predict where the stock is going. Because if you don't get the right direction, then you will make no money. But when you sell options, you will make money as long as the price doesn't go to the point where you think it won't go. Hopefully that makes sense. It's not complex. I can even actually point to this right here. If you think the stock, there's no chance it's going to 35, here we are at 40 on AMC. If you think it's no chance it's going to 35 in a week, then you're going to make money. You're going to make $69 if you sold this put. Simple. Okay? But if you want to buy the call and you pay $1.89 for a 43 because you think it's going to go to 48 because 16 YouTubers and fucking Twitter guys say that it's going to run this week, so you run out here and buy a call for 189. Where's that stock got to go? It's got to go to almost 45 before you're even at break even. Okay? So if it don't go to 45, you don't make any money. But you, as the option seller, well, you can't make a fortune. Obviously, if the price of the stock went to 60 and you bought the call at 45, you're going to make a huge amount of money because you paid 150. Instead of buying the stock at 45, you paid $1.50 and you get like $15 in return. So there's a huge return there. But sorry to say, for the poor AMC apes who've been buying and buying and buying short-term calls, they're losing their ass. So when you sell an option, You're just simply always going to make the money if it doesn't do anything there, because you will be able to buy this strike price back at this premium for a very nice profit. So, and we'll get into that in a few minutes. Okay, so we talked about the yield. The yield is the first step, because if you don't have the yield, there's no point in looking any further. So when you're looking at any, and you know, this is in general for selling puts, you're looking for the yield first. So make sure you get the concept of the yield, which is 1% of the strike price equals 50% annual return on your money. That's the yield. That's the very first step, okay? And then you have to go to two techniques to define the price, especially when you're trading close to the money. And then you can decide what price that you can feel fairly safe with. Okay, for the rest of this video, I am going to use a lot of examples, and I will try to do it fairly quickly, but, you know, I'm sorry if this drags on a little bit, but I need to give many examples, and at the end of the day, I simply want this to feel for new traders, new options traders, especially put sellers, that it's really fairly simple. Okay, so here we are again at the options chain. So you want to see if you can get close to in the money or out the money, because why? You know, the closer you are to in the money, the higher the premium. Here's $223, and as soon as you start dropping away from the close to the money or in the money, you know, obviously if you can sell the 40 at 280, and the stock price goes up to, let's say, to 42, if the stock price, which is at 40, and it goes to 42, and you sold the 40 at 280 while it was in the money, you're going to make the maximum amount of profit. So first step is to simply start charting. And if you don't know anything about charting, you got no chance. So I'm only going to say, I'm going to go through the ways that you do charting in a simple way as fast as possible. And then you have to do the research, you know, yourself online. So here's AMC. This was Yahoo Finance. You know, here again, we were at 40 bucks. You know, this is I use Yahoo. I've already said this before. I'm a simple trader. I use simple shit. And so this is how I do it. So now you see all these lines, and we're drawing trend lines and things like that. So I leave this chart here for a minute, and then I'm going to go to some other charts. Right? This is the shit I've shown before. You simply get this off the internet. Okay? Look, here we are. Let's draw this in. Bullish pennant. Here, let's go back and look at where we are on AMC. Bullish pennant. Here we are. Right now, this is the weekly. Are you trading daily options, or are you trading weekly options? We're trading weekly options, so you use a weekly chart. So you can draw the lines. You're only drawing lines from the bottoms to the tops. And, you know, here they intersect. So how hard is this? This is not rocket science. Go here. Bullish pennant. That's what it looks like. So you're only looking at these charts, you know, and you need to get practiced at this. But you don't need to know this shit like 100% before you dive in and try something. Just get in there and do it. Here you see that the odds, and this is again probability, the probability is the price is going to go up here. We go here, this is where we are, and this is why on Twitter, it drives me crazy that everybody is coming out every day with, we're going to go to the moon tomorrow. Well, you know, I keep saying technical analysis works until it don't. So, you know, we don't know really what it's going to do, but you can watch this and you see what happens. And I want to make it clear. Here's a good point. I'll zoom in on this. look here. We pierced that pennant. This pennant has already been pierced a couple of times now. This is November 19th. And why does that happen? You know, when you think that that's going to rocket to the moon when it's trading up here we were at 42, 43, 44. You think it's going to go to the moon? No. When why? The market makers are simply sweeping. And I post this on Twitter all the time also. The market makers are sweeping for stops, right? So, you know, they're running things down and up here, down and up, trying to take out people's stop losses or trigger a buy order, and then they'll run it right back into the middle again. So, so you know, a firm breakout is really required, and you know, so you just have to take any piercing with a grain of salt. So there's two ways to draw these trend lines. You draw them from the very tops, or you draw them from the closes. Here you could draw a closing trend line, and it would stretch out a little bit further. So, you know, this is all charting experience, and you're not going to get this experience until you have many years. So this is not the point. The point is trying to find a good entry, and you don't need to have that much experience. You will gain that experience over years, but initially you don't need that much experience. So anyway, back to this chart. You know, you guys just simply download this shit off the internet. I've got a bunch of these. Here's this chart. It tells you what happens if it's doing this shit, and tells you what happens if it's doing this. And again, I'm sorry to be a little bit sarcastic, but this stuff takes one day, and you got the general concept. It's not hard. So, you know, what I get all the time is I don't sell calls, I don't sell any options because I'm scared. It's, you know, it's so complex and everything else. It's not complex. When you study this and you study a chart, spend 8 hours doing this in one day, and you've already somewhat got the concept. Okay, so it's not rocket science. At the end of the day, I would hope that people can simply have a little bit of confidence and not make this to be so, you know, scary. Okay, so now I pulled up a QS or QuantumScape chart, and I'm going to talk a little bit about the Elliott Wave. And if you haven't watched part 1 and part 2, you're going to be a little bit lost here, but in part 2, I showed my spreadsheet for the Elliott Wave, and that's what I want to talk about next. So, you know, you're still looking for a price, and that's the most, you know, obviously the most important part. And if you have the most amount of time to study or watch the flow and watch what's going on, then you've got other tools that you can use. So you just simply start drawing lines. You want to draw lines across the top. You know, here's a technical pattern. Here is what used to be resistance. Boom, 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 boom. Now it broke through resistance, and now it's support. See? You know, if you want to scalp, you can make a lot of money on this stuff. But, you know, so this is fundamentally how you got to be a good artist. You simply draw lots of lines, you know, across tops and bottoms and angles and shit like that. It's, you know, it's easy. And it's easy for me because I've been doing it 40 years, and I know people can be scared of new, but it's not hard. Just draw lines. Now, when you're looking for a price to sell a put, and this was a good example, and that's why I took the screenshot. Watch here. You see what the volume is? And when you follow Diver on Twitter, you're going to get all kinds of shit about velocity. And where does velocity come from? Volume. See the volume up here? 8.68 million. When you see that 6 go 7, 8, 9, 10, now you know you got some kick-ass volume. So look what happens here at the volume line. we got a big red line. Boom, 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 boom. You're watching this shit, you know. If you watch 4 times a day, you're going to see this, you know, and boom, there you get a big red candle and a big red volume bar. Now you know you're getting close. So you could sell the put here for what? A strike price down below here. Okay, I don't know what this is. I think it's, you know, like, you know, say you sold at 29 or whatever. This is trading at 38. This is when QuantumScape ran from God knows what, 25. It was really running. Okay, so when you sell a put, you're wanting to try to time the massive volume surge at the end of the fall. So here it's struggling, right? So you would see a chart pattern here. It's failing to break this top and boom, falls. When it falls, you could be a little bit patient here and wait, but through the volume surge, and as soon as you see the volume dying down, boom, sell the put. That's going to give you the maximum premium. So, you know, this is one of the techniques that you use for picking the price that you want to sell at, and picking not only the price, the time that you want to sell the put. But obviously, if you have not able to watch the market this close, you simply have to then do technical charting. So, you know, if you're looking like here, you're saying, oh, you know, something's going on, and all of these different techniques that you can use, and then you have to try to forecast, and then you pick a price out there, you know. And again, this, I know this is not simple in terms of thinking about it, but, you know, you have to look at a little bit of practice, and somehow I think it's easier to do it like this. You know, you look at AMC, here we are at 40, and you say go backwards several weeks, and then if you want to be safe, especially if you're a beginner, this is not in the money or at the money, but if you're a beginner, you simply just stay down in these areas, okay, on a weekly, because if it's a weekly, you're still pretty safe. And I've already talked to you about rolling, so if you're in video 2, you can learn about what happens if you get caught in a trade down in this area. So that's not, you know, it's not, again, rocket science. It's not difficult whatsoever. So now I'm back to this chart example that I have in part 2. So if you haven't watched part 2, you're not going to get this. But this is fundamentally, again, the Elliott Wave, a simple spreadsheet so that you can work through these numbers yourself and get involved in the chart and everything else. And it's, you know, simply bottom to top. However, this bottom and top can also be top to bottom. So, you know, this is not a good example. These are only bottoms to tops. But anyway, you can put the number at the top when you reach a top. Say here you could put 39.90 in here, 33.63, and it would just give you the opposite direction. All right, and these are, again, all the retracements and all the advancements. And I don't want to go over this again, because if you haven't watched part 2, then go back and watch part 2 and get this. Okay, so this is QS, QuantumScape, and how I do this is I'm putting in the lowest price, and this would be the initial Elliott Wave move, the very bottom. Okay, and we need a double bottom, and so far I haven't proved out that this has been a double bottom. Okay, then I put the next run up, and don't pay any attention to this, because this move will go into the first move up, because in the Elliott Wave you have wave 1, 2, 3, 4, 5. Forget about everything else. Just think 1, 2, 3, 4, 5. 1 up, 2 down, 3 up, 4 down, 5 up. Okay, there's major moves and minor moves. So, you know, go back to video 2 if you want to learn that stuff, or go especially to the internet and learn the Elliott Wave. But when I'm working through a trade, I simply put in the bottom and the top, and then I highlight where we are. And I say, okay, if we do this, we're going back to here. If we do this, if we retrace, we're going back to here. If we advance, we're going back to here. Okay, and here's one on AMC. So I did, I've showed this one also in part 2. There's all kinds of stuff. I'm just coming out here. I've started locking in some numbers. Okay, you can see the very low back at 218 all the way to 72.62. And then I start highlighting, where we could be and where we might go. This is beyond the scope of this video. I only want to show you that this is, part of what you do in order to pick a price. Okay, if you don't know how to do this, then you should learn to do this as soon as possible. But is it required for your very first options trade? Not really. This is more advanced type of stuff. When you're trading options, you can learn how to stay below these chart patterns. And when you can figure out chart patterns at the very basic level, and you get comfortable with a stock, then you can start selling put options, and you can generally make premium and probably not get assigned. And if you especially watch part 2 on how to roll, you won't get assigned, and you can trade and make money and not worry about anything. So if you're going to try to select a price to enter, you need to understand how max pain works. So there's a website called MaximumPain.com. And every time you open the website, it gives you the time it's created, the stock price, and the max pain. And what is max pain? Max pain is simply where the strike price is that causes the most people who are in a put position and the most people in the call position to lose money. So why would somebody want to do that? Well, the market makers, they want to make the most money, just like all of us. So, max pain is they make the most money and everybody else loses the most money. So, and here we go. Perfect example for this video at the time it's shot. It's November 19th, expiration date, and the max pain is 40. Okay, look here. Interest, AMC open interest chart, maturity equals 1119. Created on the 13th of November. Where is the price of AMC? 40.65. And this is 1119. So I don't know what to tell you, but it seems to work. But it doesn't always work. So 40 years of trading, 20 years of option trading, doesn't always work, but quite often it does. So, there it is. We're at 40.65 at the time I took this screenshot, and max pain is at 40. So this is a critical point. So it's not so easy to explain, but if you look at open interest, this is 10,000 contracts. Boom, 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 boom. There's 20,000 contracts in the green, which are the call contracts. And then it just goes on all the way up to 94, way up 30,000 open interest. Just 30,000 contracts. That's 100 shares each. That's a lot of shares. So you need to understand that the market makers are going to try to pin the price. And how can they do that? Well, they have all kinds of methods to do it. They can come up with naked shorts. That's the word everybody hates to hear, but it's legal. Market makers can do naked shorts. They can do whatever they can't want. They want to hit this max pain number 40. So you simply need to know this number, max pain. MaximumPain.com, max pain 40. Okay, stock price at this time that this was printed at November 13, 614 is 40, and the stock price was 40.14. This maximum pain is printed in weekly increments. So you simply go to this website, you go 1 week at a time and go out 6 weeks. Pay attention. 6 weeks. You go out from 11/13 if you want the date. And you're looking at max pain 40, 39, 41, 42. You know, and you go out to January 22nd, which is actually unusual for AMC. It's at 20. The max pain is at 20. But then you go out one more month and it's at 41. That's crazy. So anyway, you know, it's not a perfect number, but it's a tool. Understand the tools that you have. There you have that number to take into consideration. So these are the tools that you have. Elliott Wave. You have Elliott Wave, min, max, retracement 23%, advanced 23%. Figure those things out. Make it simple. Don't make it complex. It's not hard. Max pain, min-max what you can get out of your Elliott wave, and the charts. What pattern are you in, and where can you be under the pattern or peek at the pattern or whatever, and that's the price where you find to pick. So this is the key. Take what you can and pay attention to what makes sense to you. So I did a bunch of screenshots just for examples. So here we have, you know, this is the Elliott Wave, how it's created on, guess what, tradingview.com. And it's free. You click on some chart tools or whatever and it'll give you the Elliott Wave. There it is, AMC Entertainment. Stock price, Elliott Wave, and you get all of the advancement, retracements, and here we go. Look, 2, 3, 3, 8, 5, 6, 8, 1, 7, 8, 72.68. These are all the same things I have on my spreadsheet. This is just one example of what tool you can use on the internet. Now, again, here's my, I'm sorry, I'm laughing, but this is my simple spreadsheet. I just do it with, you know, a spreadsheet. It's so easy. I put the small number in there and I put, you know, this is wave one. I'm waiting to see where it ends up. And it was the first move. Here is where I show you the bottom actually is the top and then the bottom. And then we go along and look, it went from 748 to 1720. The stock is Workhorse, WKHS. I'm trading this stock. It goes from 748 to what? I don't know. 748, it went to 1720, but it's not locked in yet because we don't know how far it's going to go. So that was a move. And then it went from 1720 to 870. And then I highlight these two numbers because the last time I looked when I did this screenshot was 870. Okay? Now watch. Here we go. Now, ooh, I've changed the whole fucking thing. It's now 602 because Workhorse, sadly to say, it just keeps dropping. You know, and I have 300 shares of this shit. I'm not ashamed to admit it. I'm trading this, and I'm making money pretty much every 2 weeks or so on selling options. But anyway, so it went. So now we're at 602. I've just moved this number down, and we went from 18 to 602. Then we went from 602 to 780. And there's all your numbers. You just highlight them. Okay. Do I want to sell a put? Maybe I sell a put at 650. I hesitate because I want you to understand. Think about what you're doing. The Elliott Wave gives you a price entry point. So we look at 640, and then we look at the chart, and then we look at the yield, and there you make your price. If you get a yield of 5%, are you going to get that in the bank? Fuck no. So sell the fucking put, take the yield, and be happy. It's that simple. It really is not rocket science. It's easy money. You make money month after month, year after year. You don't lose any money. I'm going to say this again. I haven't lost any money in the options market in 21 years. The only time I ever lost money on a stock was because the company went bankrupt, but never have I lost money on one single options contract. So all the people who talk about, oh, options traders are losing money. They buy calls. Fuck them. Sell options. You never lose money because trust me, if that price dropped to 550, I'll show you how to roll it to 450 to 5. Okay, there is an occasion where you could lose money, but I have yet to meet it. I know that the occasion exists that I could lose money, especially on a call option if I sell a call. But when I sell a put, never happens. Actually, it's never happened on a call either, but it could. And I will explain that in just a few minutes. So I want to go back to Max Payne just to give an example, and this is another example, just to give you more or less, different scenarios. So here we are at Max Payne, and this was shot at 11:13, and the Max Payne was 40, and this is expiration for 11:19. Max Payne 40, and you see all these open interest. Green is call, red is put. There you get the max pain is 40, and that's where the market makers want this to be. So they go to 40. So look now. Now we're at the strike price. Today on 11:19. Here we are, intraday 40.65. Okay? It's max pain. So this is 11:19. If you were going to sell options on 11:13 and you would say, okay, everybody's predicting that the stock 40.65 is going to trade somewhere around 40 to 41, then I want to sell a call or sell a put somewhere in between there. This week, I sold a 44, a 45, a 50, a 55, a 58, a 59 call, and 236 puts. And I made a fair amount of money in 1 week. So, this is the point. You're coming around these max pain numbers and recognizing that max pain doesn't necessarily, hold true every time. So you gotta be cautious with that. You gotta look at charts, and no matter what all you do, you use charts, you use max pain, you use all the tools that you have, and you may still be wrong. And what do you do then? Learn how to roll, because when you roll a stock, you don't really care. You just move it out to another date. Here we are back to max pain. And you have some curves. This is a little bit more complex, and for smooth brains like me, I don't fucking understand it, but I can give my best shot at explaining it. So you have a delta 1, and there it goes, and there's a curve. Okay? So this is fundamentally premium. You see, premium is, what the fuck is that? Nothing. And then all of a sudden it drops. This is simply a curve, and it relates to delta slash premium. Okay? I'm not very good at explaining this, but I'm giving it my best shot. Okay, so look, if you have a delta, you see here delta 0. Let's come over here. You got a delta 1. So delta 1, delta 0. I just want to show an example. When delta 1 on a call, look at these premium numbers. $17 a share. course, that's on a 23 strike when the price is at 40.70. So, you know, this is huge premium. So those people, you got to understand this. When those people bought a 22 strike call, whatever the price was when they bought it, the current premium is 18.55 when the stock price is 40.70. Okay, so it's now a delta 1. Now you go to the put side. This is the put side. When you go to puts, the delta is 0. See how it's now approaching 0. And on the put side, on 31, it's worth nothing. Okay, so that's the concept of delta. And when you look at the curve, it's just simply going from 1 on the call side to 0, and on the put side from 0 to 1. So when you're at a 1 delta on the put side, you're huge in the money. But now look how that works. You're huge in the money when it's, you know, right now we're at a maximum pain of 40. 40 is the tangent point of the curve. Look, from 34 to 50, the fucking premium is shit. Okay, so you're looking for a delta 34, 35, 36 to 44 or so. This is the delta you're looking for to get any kind of premium that makes sense. Because when you go out here, if I went out to 70, the premium is shit. If I go to, you know, 22 on a put, it's shit. This is how delta works, and this is for you after you have much experience. But do you care about this right now? Not really. You only care about charting and maximum pain and Elliott Wave. Pick your price, stay out of trouble, or buy the stock when you want with a put call, and then, you know, you're in the money. So it's that simple. So, and I want to show one more example of rolling so that you really get the point. So I did this screenshot. Look, filled 63 cents, sell 1 November 5th, 41 call. 63 cents. Okay, so, you know, this isn't very exciting. I got a little bit of money for selling this call. Okay, so what happened? Now look at the dates. November 5th. So I sold the November 5th call, and the price ran against me. So what can happen when the price goes up? On a call, you will lose your shares. They can get called away. So let me show you what you can do. November 5th, that's the options chain on a call side. Okay. So when you sell the strike price, this is like a 41 call. When you sell at that strike price, you look at the bid and the ask and the filled price. So this was 63 cents and somewhere in this range. And so what happens? What happens when you sell a call and the price goes up? You see where the price is right here, 36, but the price went all the way to 42. So when the price goes to 42, obviously this bid amount is going to go up and up and up and up. So it went to something like $2. And now I'm either going to have to give up my shares and keep my 62 cents profit, or I can buy the option back, close it, and spend $200 and lose money, or I can roll it. And now I show you what happens when you roll it. I rolled that, look here, January 22nd. Filled, $40 call, $10.05. That, you know what I made on that? $1,050. And what did I do? I paid off the $200 call that I was in with, and now I have $800 profit. However, I'm waiting till January 22nd. But you know what happened? The price fell back to 40, right? And I bought the call back for, I would say, and anybody following me on Twitter and Discord would see the exact numbers, but off the top of my head, I bought it back for like 800 bucks. So I made $200 profit. We're talking about a period of less than a week, and there were no problems. So that you need to understand is how to roll. But do you need to know how to do that when you're on your very first trade? No, fuck no. You just simply need to understand the concept, and you need to trade a small, dollar contract until you try it a few times, and then once you get the hang of it, it's easy. It's, you do it once and you got it down. It's not a problem. Okay, so the last few examples, because this is dragging on, and like I said, I'm not really very good at this, but Fibonacci numbers, this is the Elliott Wave. This is all the shit that goes on. You can read it, you can understand it. It's not rocket science. It's easy. General wave structure, Fibonacci numbers. This is how my spreadsheet is set up. This is wave 1, 2, 3, 4, 5, ABC. It goes on and on. It's mini waves and maximum waves. It's simple. Here I bring this one up because I want to give you an example of a high volatility day. I sold filled 660 sell 1 January, $50 call, 660 bucks. Must have been somewhere around the third week of October. I sold this call at 660 bucks. I think here, yep, here it is. This is my trade, $660. And I closed it 2 days later for like 400. So a couple $100 in 2 days. So I'm just saying, when implied volatility 115%, whenever you're over 100%, the premium is usually pretty good. So there this is implied volatility. Look for 100% or better. If you have less than 100%, then you got to look back at yield and all this kind of stuff. But again, this is just an example of implied volatility. And look at the theta. What does theta mean? It's simply the amount of money you can make per day. Don't think of it in all kinds of complex terms. It says 0.049. That's 5 cents per day. This option will decay in price based on everything being the same. Now, if the price goes down or up, it's going to change. But based on today, I can make $5 a day, $10 tomorrow, $15 the next day, $20 the next day. That's theta. So what are you doing when you sell options? You're selling theta. One very important point, and I brought this screenshot up for future fuel because I'm also trading this. I like the stock, and actually I like the fact that its cash burn is very low. But from an option standpoint, it's critical to understand where your yield is at. And this is a good example of that. Okay, so I circled these numbers. This stock is trading at 891. So look, a 750 is only selling for 5 cents. And there's no bid, no ask. If you have no volume is 5, you really have to pay attention to what kind of volume and what kind of open interest. You know, when you have 1,074, that's reasonable. All right, but when you have 5 and 223, this is creating a problem for you. So for me, I own the stock at $9. So I don't mind. This is okay. Sometimes I sell it as a premium and sometimes I don't. And, but I'm never going to make much money. Although I will over time, I've made a reasonable amount of money. I make more than 5% per year. However, if the stock does never run, it's not very exciting. So, when you compare this to AMC, you're making a shit lot more money on AMC than a stock like this. But just so you understand, no matter what stock you're trading, no matter what you're doing, you can sell options against your stock holdings and make money. And you only need to know how to be careful when to place the trade and how to close it so that you don't get locked into the trade. And this, again, is about rolling. Okay, one thing I haven't really totally made clear is how you close an option. So it's important that you see down here in the order book, it says AMC filled 48 cents, sell 1 November, call 46 cents, limit to open. Okay, I posted this also on Twitter. I post all my AMC trades on Twitter so that so here I want to explain that on November 12th I closed this. In other words, you have bid 46 cents, ask 48 cents. So I sold it at 48 cents. Okay. Then I bought it to close. Buy to close. We don't ever go to expiration when it comes to November 12th. This is a November 12th expiration. Stock price is 38. The strike price is 41. You see my little trade symbol. 41 is the strike price. The stock price is 38. And that was on this date, November 12th. So on this date, and I did make a screenshot, and I'm sorry, but if I made the same screenshot, this would have been 1 cent and this would have been 2 cents. So in 1 cent, I simply put a buy to close at 1 cent and boom, I get 1 cent filled, 1 cent. So that means I made 47 cents, $47 because it's 100. Profit on this particular trade. So, obviously if that's $8 and I bought it back for 1 cent, that's $800. So, this happens quite often also. So you have to understand how to buy to close. And I explained that also in part 2. So just opening up this one more time to kind of review. This is how you do it. Sell open. You sell open a put at the bid or at the ask or however you want, limit price, preview order, place the order. And the same thing here. So this is the action, buy, close. So when you want to close out an option, you got to, do the same thing, expiration, strike, put, and bid, and whatever. And then you have to pay out. So again, this is covered in the first video. I wanted also to cover a put chart just so you get a sense. So when you are on an options page and you click on the chart of the option, not the stock, the option. So this is a January 21st, 2022, 39 put. That's the strike price. This is the option price. This is AMC. So the bid of the option is 715 and the ask is 730. I only wanted to show you this because over time, if you look at from June till now, over time theta decay just eats away at the premium. So when you sell premium, if you can sell it up here, you only need to just take a nap and eventually the premium goes down. Now, obviously, if the stock went to 300, you might, that's the key. You have to decide when to sell and when to buy and blah blah blah. But decay works like this. So if you just look at any stock, any option, decay, it has its moments where it runs up and it has its moments where it runs up, but over time, theta decay just eats away at the premium. And that premium, when you get the big premium and it eats away, allows you to buy it back here, somewhere in this area, right? If you sold this option at 22.50, now you can buy it back at 7. Who gets the money? You. All the options buyers who bought this 39 put, if you are on the opposite end of this trade, you have to always fight against theta. And so, there you are going to have a harder battle than the person who is selling. So some of my last comments are, you have to make decisions on when you're going to do this. So when you're 90% confident you know which direction the stock is going to go, then you would trade in the money or at the money. When you're not sure, you trade out of the money. So I've explained all of those concepts. So that's when you decide. If you're an expert at, I shouldn't say, because anybody watching this video is probably a beginner. But if you're a beginner and you at least have some confident sense of where the stock is going, then you want to trade in the money or at the money. And you use chart patterns to solve that. If you only want to collect premium, then you simply sell out of the money puts and you stay away from where you might get assigned. And what does being assigned mean? Okay, so make sure you really understand that. That's the word assigned. It works both ways. If you're assigned on a put, you got to buy the stock. If you're assigned on a call, you must give up your shares. Okay, make sure you understand that part. So anyway, I think I've covered all of it. I hope that this is helpful. I didn't get really into detail on selling calls, but it's exactly the opposite of selling puts. So it's not a complex deal. Okay, in summary, it's easy. You can make it happen on any stock that is reasonable within your price range. And if you don't know any stock, pick one under $10, look at the options chain and try to figure out whether it fits your budget, let's say. I'm going to summarize everything that we've talked about in this video. First, you're looking at the yield. And here we are back at the GE stock. If the yield is less than 1% of the strike price, forget about it. Go for 1% or better of the strike price. Okay, step 2, look at the weekly chart. Here's the weekly chart. Look how many weeks this is. 1, 2, 3, 4, 5, 6, 7 weeks of weekly charts in this little small range. AMC, 40 bucks. You're looking at this range. Of course, if you get caught in this spread, that's different. But, you're watching things happen as they happen, and you're looking at the charts, and you're learning how to do things by charting. And then back to this chart. We're trading off of chart patterns, and it's either below the chart pattern or above the chart pattern, or whatever you're trying to achieve. Most of the time it's in a pennant, or it's in a head and shoulders, or it's in an inverse head and shoulders, or whatever. And these are reversal and extension patterns. And so it's really not that many patterns. Step 1 is the yield, and step 2 is the chart pattern, and step 3 is max pain. Okay, and once you have figured out the price that you want, simply go in and sell the open. Okay, how much risk do you have here? If you sell to open, AMC, this is an old one for $37.19, but let's say it's $40, and you sell to open a put contract at 36, and you get 50 cents. You only need to think about how much risk there is for the price to drop to that point. And if it drops to that point, I've already showed you how to roll it. So this is a simple concept. Learn how to do a sell to open and a buy to close. So as soon as you're in the money and you're happy, and when you're brand new at this, be happy with 10 bucks. Be happy with 15 bucks. I don't know, man. Just be happy when you make a profit, because over time, when you make profit every week, and like me, I make profit for 22 straight years, never a loss. When you can do that, what can I say? How can you be unhappy about that? It's simple. So again, that's a summary. And I'm going to kind of summarize on the concept of selling calls. If you sell 1 million puts, you're going to freeze the option chain on the bullish side. That means the stock should go up. If you sell 1 million calls, that's going to be on the bearish side. So, I sell puts and I sell calls. The difference between me and the average, let's say option seller. If I sell a call at strike price 44 and the option gets assigned, which means my 100 shares, I sell one contract at 44 and my one contract gets called away. That means somebody else takes my 100 shares away on expiration date. What do? I sell an immediate 44 put, which means I'm swearing to buy that contract back, 100 shares at 44. So I'm never going to cause any damage to the AMC ape cause. Cheers and all the best.